Everyone's predicting China's economy will crash tomorrow. Are they right or are they wrong? Hey, I'm Captain Clue. I'm a qualified government accountant. Today, we're lighting the torch on one of the most fiercely debated topics in global economics. Is China's economy really on the brink of collapse? Is it? Is it? For years, headlines have warned about China's economic bubble, massive debt levels, and unsustainable growth model. So what's really happening? Let's see the evidence and where this could all go very, very wrong. To understand China's current challenges, we need to first understand how China became an economic superpower in the first place. China's growth miracle over the past 4 decades has been driven by a simple but powerful formula: massive investment in infrastructure and manufacturing, export-oriented industrialization, strict capital controls, gradual market liberalization, and state guidance of key economic sectors. These strategies collectively fueled rapid development, transforming China into a global economic powerhouse. However, as the country faces new challenges, examining this foundational framework provides crucial insight into both its past successes and future obstacles. This model delivered astonishing results. China maintained an average annual GDP growth of nearly 10% for over 3 decades, lifting 800 million people out of poverty and creating the world's largest middle class. However, this investment-heavy model also created significant imbalances. China consistently invested over 40% of its GDP back into the economy, far higher than the 20 to 25% typical in most developed nations. This excessive investment led to several structural issues, including the overbuilding of infrastructure, excess manufacturing capacity, and rapidly growing debt levels to sustain such high spending. Additionally, the relentless focus on industrial expansion contributed to severe environmental degradation. At the same time, domestic consumption remained relatively weak as the economy prioritized production and investment over household spending. These imbalances have become key challenges for China as it seeks to transition toward a more sustainable and consumption-driven growth model. China's total debt has surged from about 150% of GDP in 2008 to over 300% today, encompassing government, household, and, most critically, corporate debt. For context, the United States' total debt stands at roughly 350% of GDP, but its economy is far more mature and diversified, making its debt burden more sustainable. What concerns economists is not just the sheer scale of China's debt, but the speed at which it has accumulated. Historically, such rapid debt growth has often preceded financial crises in other countries. Yet China has managed to sustain its high debt levels so far due to several unique factors. First, most of its debt is domestically held rather than foreign denominated, reducing exposure to external shocks. Second, the banking system remains largely state-controlled, allowing the government to steer lending and manage risks. Third, China's exceptionally high domestic savings rates provide a stable funding base for its debt. Fourth, strict capital controls help prevent large-scale outflows that could destabilize the financial system. Finally, the government retains the ability to direct resources and bail out troubled sectors when necessary. While these mechanisms have helped China avoid a crisis thus far, the long-term sustainability of its debt-fueled growth model remains a critical challenge. Real estate has emerged as the most visible symbol of China's economic imbalances. The property sector plays an outsized role in the economy, directly and indirectly contributing an estimated 25 to 30% of GDP. It also holds immense financial significance for both households and local governments, representing roughly 70% of household wealth and generating 30 to 40% of local government revenues through land sales. For decades, Chinese households have treated real estate as their preferred investment vehicle, seeing it as a safe and lucrative store of wealth. About 90% of urban families own their homes, with many holding multiple properties. This deep reliance on property stems from several factors: limited investment alternatives due to strict capital controls, a cultural preference for tangible assets over financial instruments, decades of seemingly unstoppable price appreciation, and the social prestige tied to home ownership. However, this property-centric economic model has now become a source of vulnerability, exposing structural weaknesses in China's growth strategy. However, China's heavy reliance on real estate has led to classic bubble conditions that now threaten economic stability. In major cities, property prices skyrocketed by over 600% between 2000 and 2020, far outpacing income growth. This has created extreme affordability challenges, with price-to-income ratios in key urban areas reaching 25 to 30, meaning an average home costs the equivalent of 25 to 30 years of typical earnings. The market shows clear signs of oversupply, with vacancy rates estimated at 20% or higher across many cities as speculative buying outpaced actual housing needs. The sector's problems were exacerbated by risky developer practices, particularly the widespread model of pre-selling apartments and using those funds to launch new projects rather than completing existing ones. Meanwhile, local governments became addicted to land sales as a primary revenue source, creating perverse incentives to keep the property boom going. These interconnected factors have transformed what was once an engine of growth into a potential source of systemic risk for China's economy. China's property crisis reached a turning point in 2021 when Evergrande, the embattled developer saddled with more than $300 billion in liabilities, began defaulting on its debt obligations. This was never just about one company's downfall. Evergrande's collapse laid bare systemic vulnerabilities that had been building across China's real estate sector for years, exposing how developers had gorged on unsustainable debt, left countless pre-sold projects unfinished, and created a house of cards that was beginning to topple. The repercussions spread quickly. Plunging land values undermined local governments that relied on land sales for revenue, while disillusioned home buyers watched their investments and confidence evaporate. The contagion didn't stop with Evergrande. A wave of defaults followed, with major developers also buckling under their debt loads. The sector's downward spiral became undeniable as new home sales plummeted and prices began falling in city after city. Beijing has rolled out a series of interventions to stem the bleeding, from relaxing mortgage rules and cutting interest rates to establishing bailout funds for stalled projects and pushing state-owned firms to absorb distressed assets. Yet despite these measures, the property market slump persists, acting as an anchor on China's broader economic growth. The crisis has made clear that the old playbook, where construction cranes never stopped moving and prices only went up, is broken, leaving policymakers to grapple with how to stabilize a sector that was once the economy's most reliable engine. China's shadow banking sector presents another systemic risk, having ballooned to 90% of GDP at its peak through wealth products, trust loans, and opaque local financing vehicles. While regulators have reined in the worst excesses, the sector's legacy remains dangerous. Many assets tied to troubled property developers and local governments remain obscured by financial engineering. This hidden leverage creates contagion risks that policymakers must carefully unwind without triggering the crisis they aim to prevent. China's local debt crisis poses a major threat to financial stability. While official figures show 30 trillion yuan, 4.5 trillion, in debt, the real burden likely doubles when including off-balance sheet financing. This stems from China's fiscal imbalance. Local governments handle 85% of public spending, but receive just half of tax revenues. The property downturn has dried up critical land sale revenues, exposing years of reckless borrowing through opaque financing vehicles for unprofitable infrastructure projects. Small bank runs have already occurred as the system strains, revealing how local finances, property markets, and banking stability remain dangerously linked, with the central government forced to contain the fallout. China's most daunting long-term challenge is its demographic crisis, a legacy of the one-child policy that created a perfect storm of aging pressures. With a fertility rate of just 1.3, among the world's lowest, a shrinking workforce, and projections showing over a third of the population will be over 60 by 2050, China risks growing old before getting rich. This shift threatens economic fundamentals. Rising pension and healthcare costs will strain public finances, labor shortages could erode competitiveness, and declining housing demand may collapse property values. Unlike Japan or South Korea, which aged after achieving advanced economy status, China faces this crisis as a middle-income country, with its former demographic dividend now reversing at an unprecedented scale. The timing leaves policymakers with few good solutions to this existential threat. Meanwhile, external pressures compound these domestic challenges. China's domestic economic struggles are being exacerbated by a rapidly shifting global landscape. The country now faces mounting external pressures, including stringent technology export controls imposed by the United States and its allies, which are targeting China's ambitions in semiconductors and advanced manufacturing. Simultaneously, multinational corporations are actively de-risking their supply chains, moving operations out of China or establishing alternative production bases in countries like Vietnam, India, and Mexico. This trend reflects both geopolitical calculations and economic realities as China's once unbeatable manufacturing advantages erode with rising labor costs. The data underscores this worrying trend. Foreign direct investment, the lifeblood of China's early economic miracle, has slowed to a trickle. Global protectionist winds are blowing stronger, with trade barriers and friend-shoring initiatives redirecting investment flows. While China remains a manufacturing powerhouse, its position is no longer unassailable as emerging competitors offer cheaper labor and Western nations prioritize supply chain resilience over pure cost efficiency. This dual challenge of technological containment and manufacturing migration threatens to undermine a key pillar of China's growth model, just as it grapples with domestic economic headwinds. The intensifying strategic rivalry between China and Western nations is generating significant economic turbulence, compounding China's existing challenges. Beijing now faces a series of technology and investment barriers that threaten its development trajectory, from stringent controls on advanced semiconductor exports to growing roadblocks against Chinese tech firms' global ambitions. Western nations have ramped up scrutiny of Chinese overseas investments while scaling back critical technology transfers and scientific cooperation, effectively erecting barriers around key innovation ecosystems. In response, China has rolled out its dual circulation strategy, aiming to pivot toward self-sufficiency in critical technologies and greater reliance on domestic consumption. However, this economic transition from the familiar export and investment-fueled model to one driven by homegrown innovation and consumer demand has proven extraordinarily difficult to execute. The shift requires not just policy adjustments, but fundamental changes to China's economic DNA, all while navigating an increasingly hostile international environment that threatens to deprive China of the very technologies and collaborations needed to power its innovation ambitions. This geopolitical economic squeeze presents perhaps the most complex test yet of China's economic governance model. Despite facing serious economic headwinds, China still possesses significant strengths that make a sudden economic collapse unlikely. With over $3 trillion in foreign exchange reserves, it has ample resources to stabilize its currency and financial system. Unlike many emerging economies, China's external debt is relatively low compared to its domestic obligations, shielding it from foreign creditor pressures. Its manufacturing sector remains unmatched in scale and diversity, while its digital economy and fintech lead globally in many areas. Additional buffers include a domestic savings rate near 45% of GDP, providing a deep pool of capital for investment and crisis response. Avoid costly finance mistakes. Finance Fiascos Volume 1 Raw Confessions plus mind map PDFs for bite-sized quick review of these videos. Use code CLUE10 for 10% off today only. And the government's tight control over the financial system, allowing swift, decisive policy action. China's current challenges resemble what economists call the middle income trap, when developing economies stall out before reaching high income status. However, China has several advantages: a large domestic market, strong educational attainment, particularly in STEM fields, significant infrastructure advantages, growing innovation capabilities, and last but not least, China has strategic industrial policies targeting high-value sectors. China's situation bears similarities to Japan in the late 1980s and early 1990s. Property bubble, aging demographics, high savings rate, export-oriented economy, and banking system vulnerabilities. Yep, but Japan didn't experience economic collapse, but rather entered a prolonged period of low growth and deflation after its bubble burst. China might follow a similar trajectory, not dramatic collapse, but a significant slowdown from the high growth era. Meanwhile, technological competition with the West, especially in semiconductors, AI, and clean energy, will intensify. This slowdown would reshape the global economy, weakening demand for commodities and affecting export-reliant nations. Countries dependent on Chinese consumers may see slower export growth, altering trade dynamics. High Chinese savings and fewer domestic investment opportunities could depress global interest rates, while rising labor costs will further shift low-end manufacturing to countries like Vietnam, India, and Mexico. Though less dramatic than a crisis, this deceleration would still mark one of the most significant economic shifts of the decade. Now here are the wildcards. China's economy is likely to experience gradual deceleration, but several risks could trigger a more severe crisis. Externally, a military conflict over Taiwan or other disputes could bring devastating sanctions and supply chain disruptions, while natural disasters or health emergencies, like another pandemic, could strain resources amid an aging population and fragile local finances. Any of these scenarios could turn China's slowdown into a full-blown crisis, with far greater global consequences than a managed decline. This transition will reshape global trade and investment patterns across industries. China's economic transition requires investors to strategically rebalance their portfolios. The most critical adjustments include reducing exposure to commodities dependent on China's shrinking construction sector and avoiding companies with significant property market risks. If you like this video, please do make sure to like and subscribe. It does help the channel tremendously. And let me know your thoughts on China, whether you're at the far end of believing that yes, a collapse is imminent, or you believe that this will likely wash over given the amount of authority that China has within its own economy. I'd love to hear your thoughts down below. Thanks for joining me, and as always, be safe out there.